Good morning, everybody, and welcome back to Morning Markets on Thursday, the 30th of April. We're bringing to the end what has been a very eventful month for asset markets. Just looking at overnight performance, what we've continued to observe is ongoing strength in the equity markets across the globe. Started in Europe yesterday, and that continued to build in the US overnight, with the technology and growth focused Nasdaq increasing just close to 3.5% on the day. That takes it close to where it had started 2020. So I think we're about 1% away from the starting point of the year, and 6 or 7% off its all-time high, which seems like a strange thing for me to be saying, given the environment that we're currently living in. What has supported that rebound? I think one of the things over the past number of days has clearly been the delivery of earnings results from a number of the important components of the technology sector, or the FANGs as they're affectionately or unaffectionately known at this point in time. So I mentioned Alphabet yesterday. Facebook and Microsoft reported overnight, and both of those indicated that their business models remain resilient in the face of the challenges that COVID-19 is presenting. So both of those stocks had positive performance in the after-hours market, which usually gives us some indication as to how they're going to perform when the US market opens today. The other things that I think we discussed today that are of relevance are around the Federal Reserve meeting yesterday and the press conference which followed that. What can we take from that? That the US Fed are continuing to evaluate the actions that they have taken, but are poised, and if it is required, will take further action to support the economy through the recovery phase. And I think one of the key things that I take away from it is that they're very much focused on their twin mandate of full employment, and also focusing on the inflation backdrop. So that to me suggests that rates are going to remain very low for a considerable period of time, and the support will be there until we see that strong recovery and robust recovery as it's framed in the FOMC statement. That is what has happened out of the US. I suppose today we have the ECB, so it will be interesting to see their take on the current situation, what they have done, and more importantly, I think what they will continue to do, or what they can do in the future to support the Eurozone. On the economic data front, we had first quarter GDP from the US. We've also seen the first quarter GDP from France this morning, and we'll continue to see a number of reports from the Eurozone through the course of the morning. Clearly, they indicate and capture the initial phase of the lockdown, with very significant and steep falls in consumer expenditure evident in both the French number and the US number. But I think that's known news, so I think the market will look through that at this point in time, and just trying to get a sense of how the lockdowns evolve and how economic activity actually returns to what could be a more normal level going forward. In China today, we've seen the PMI, so the Purchasing Managers Indices, both at a manufacturing and service level. Mixed messages there. I think what we can take away from it is that services continues to recover. On the manufacturing side, it's a tale of two stories effectively. One, the domestic economy, which continues to recover, but then the export market, which continues to remain challenged. Why is that? Purely because the lockdowns that we're experiencing across the Western economies at this point is curbing the export potential from China. So a tale of two different stories within one economy, I should say. I think the other thing just to take away from the numbers is the ongoing deflationary impact that we're seeing. So inflation and price expectations continue to fall, just reflecting what we've seen in commodity prices over the past number of weeks. So that's it for today, and please join me again tomorrow. Thank you.